For the first time in American history, all three major credit agencies have downgraded the United States. That means every dollar you borrow just got more expensive. Your mortgage, your credit card, your car loan, none of it is set by you. It's anchored to a treasury rate that just got repriced. In 2011, one downgrade wiped out $500 billion in a single day. This is all three.
In May of 2025, something happened that had never happened before in American history. All three major credit rating agencies, Standard & Poor's, Fitch, and Moody's, had now officially downgraded the United States of America. The headlines moved on in 48 hours, but the bill didn't. And the bill is already showing up in your mortgage rate, your car payment, your credit card statement, your retirement account. Most people have no idea these things are connected. By the end of this video, you will. And more importantly, you'll know what to do about it before the next wave of that bill arrives. Let me show you exactly what Moody's actually did. Because the language is technical and the consequences are anything but. Moody's stripped America's AAA rating, the highest possible, and moved it to AAA1, one notch down on a 21-notch scale. Sounds small? Here is what it means in plain language. The United States government now officially costs more to lend money to. And when it costs more to lend money to the US government, it costs more to lend money to you. Here is the chain. When Moody's downgrades US credit, investors demand higher yields to hold US Treasury bonds. Treasury yields go up. Mortgage rates track the 10-year Treasury yield almost directly. Within days of the Moody's announcement, the average 30-year mortgage rate climbed back above 7%. If you have a $350,000 mortgage, every quarter point increase in your rate adds roughly $50 a month to your payment. That is $600 a year from something you had no say in. Credit cards work the same way. The average American credit card rate right now is 20.12%, the highest in 14 years. Moody's didn't cause that number alone, but every downgrade, every rate pressure, every signal of fiscal stress pushes that number higher. 20% interest on $10,000 in credit card debt is $2,000 a year, just to stand still. Now, here is what the downgrade actually tells us, and why it matters more than the one-notch move suggests. In 2020, the United States paid $514 billion in interest on its debt. By the first quarter of 2025, that number had more than doubled to $1.1 trillion. In 5 years, the interest bill on America's debt doubled. It now consumes 34 cents of every dollar the government collects in taxes. 34 cents out of every tax dollar. Before a single road is paved, before a single veteran is paid, before a single school opens. This is why Moody's moved. Not because of one bad year, because of a structural trend that shows no sign of reversing. Now, this has happened before, and the last time it did, we got a clear preview of what follows. August 5th, 2011. Standard & Poor's downgraded the United States for the first time in history. The Monday after that announcement, the Dow Jones dropped 635 points, the single largest point drop since the 2008 financial crisis. $500 billion in retirement savings evaporated in one trading session. People opened their 401k statements that week and couldn't understand what had happened. What had happened was this. The signal from S&P told global investors that US government debt carried more risk than they had assumed, and they repriced everything that touched it, simultaneously. Stocks, bonds, pension funds, retirement accounts, all repriced in one day. Now, Moody's has done the same thing, but this time it is the last agency. There is no AAA rating left to lose. This is the floor. And JP Morgan Chase, Bank of America, and Wells Fargo were also downgraded alongside the US government. Because they hold significant amounts of treasury bonds, when treasuries get riskier, so do they. Here is what this means practically. The banks that hold your deposits just got downgraded. The government that insures those deposits just got downgraded. The bonds inside your retirement account just got downgraded. This is not the end of the world, but it is the end of pretending these things don't connect. So what do you actually do? Let me give you the specific moves, not theory, actual steps.
Hey, real quick, can I take a quick break? And this one's a short one. A credit downgrade is a mortgage problem before it's anything else. Rates rise, payments rise, buying power drops. If you don't have a strategy for what rising rates do to your real estate position, the Mortgage Master Bundle is where to start. Check out the link down below to get the whole package, one place, and start saving money right now on your monthly payments and a ton of money over the life of your loan. All right, with that being said, let's get back to the video.
First, if you are carrying a variable rate mortgage or planning to refinance, understand that the window of lower rates may have just closed. Get clarity on your rate structure now, not later. Second, your credit card at 20% is not going down. It is more likely to go up. Every month you carry a balance is a month the downgrade is literally charging you. The single most impactful financial move most Americans can make right now is to pay off variable, high-interest debt before rates climb another notch. Third, open your 401k and look at your bond allocation. Bonds are supposed to be the safe part of your portfolio, but when yields rise, bond prices fall. That safe part may not be as safe as the label suggests. This is not financial advice. I'm not your advisor. But these are questions worth asking someone who is. Fourth, the 34% of tax revenue going to interest payments has to come from somewhere. Services get cut. Costs shift to states. States raise taxes or cut programs. Those cuts eventually reach your county, your school, your roads. The downgrade is not just a Wall Street event. It is a slow pressure on the cost of everything government provides, working its way down to you. Here is the timeline that concerns analysts most. The Congressional Budget Office projects interest payments will consume 40% of revenue by 2030. That is a trap that gets harder to exit the longer it runs. Every year rates stay elevated, the debt gets more expensive. The more expensive the debt, the less room for anything else. The less room for anything else, the more pressure on rates. It is a cycle with no easy exit. The people who came out of the 2011 S&P downgrade without damage were the ones who understood their exposure before the Monday morning open, not after. They knew their bond allocation. They knew their variable rate debt. They knew how much of their savings was inside institutions that just got downgraded alongside the government. Here is the honest summary. Moody's downgrade is not a crisis by itself. It is a confirmation that the fiscal direction of the United States has been deteriorating for more than a decade, and that the people responsible for fixing it have repeatedly chosen not to. The result of that choice is now arriving in your mailbox, in your mortgage statement, in your credit card bill, in the yield on your savings account that still doesn't keep up with inflation. The downgrade did not create these problems. It officially acknowledged them. And now the cost of pretending they weren't there is being distributed to everyone who borrows, saves, invests, or pays taxes in America. If this helped you understand what you're actually looking at in your financial statements, share it, drop a comment. This information should not require a finance degree to find, because the question is not whether America's debt problem is real. Moody's, Fitch, and Standard & Poor's have now all officially confirmed it is. The question is, when did you find out, and what did you do about it?